Okay, let's unpack this. We're diving deep into the latest from Pure Storage, specifically their first quarter of fiscal year 2026.
Hmm.
The big news dropping. Strong financial results. I mean, a major player right at the heart of enterprise data storage.
That's right. And we've got a stack of sources here. The official press release, their earnings slides, which are pretty detailed, and also a useful summary from an analyst.
Right.
And our mission really is to slice through all of it to get to the absolute core. What's truly driving their performance right now? Where do they see themselves going next?
And what are the essential insights you need to know if you're following this space?
Exactly.
Exactly.
Yeah.
So instead of you having to wade through page after page of reports, we've done the digging to pull out the most important nuggets.
Good plan. So where should we start? The Q1 numbers.
Let's jump straight into those Q1 FY26 numbers, see what they tell us.
Okay. Starting at the top line, total revenue for the quarter came in at $778.5 million.
Yeah.
Now, compared to the same quarter last year, that's a solid 12% increase.
12%. Solid.
Yeah, as their CFO, Kevon Chrysler, described it was a solid start to the year. Pretty straightforward, really.
But here's where the story gets, well, really interesting, I think, and where Pure Storage is putting a ton of focus, subscription services.
Absolutely. The growth here is significantly faster than the overall revenue number we just mentioned.
Right.
Subscription services revenue alone grew 17% year over year. It hit $406.3 million.
Wow. Okay.
And if you look at their forward momentum,
Rah.
subscription annual recurring revenue, ARR, that key metric, right?
The predictable revenue stream.
Exactly. Predictable revenue over the next 12 months. That reached $1.7 billion. That's an 18% jump from a year ago.
18% on ARR. And, okay, maybe the number that jumped off the page most for me in the subscription world was the total contract value, TCV, specifically for their storage as a service offering.
Yes, the Evergreen One type deals.
That segment saw sales shoot up a massive, almost eye-watering, 70% year over year, 70 to $95 million.
That 70% growth in storage as a service TCV is absolutely remarkable. It's not just a number. It signals a really significant acceleration in how enterprises are choosing to consume storage.
It really does.
And the sources mentioned this growth was fueled by both those large strategic Evergreen One deals and what they called higher velocity transactions.
Meaning faster, maybe smaller deals too.
Exactly. Suggests this consumption model is moving beyond just the largest enterprises. It seems to be getting traction in the broader market maybe faster than many expected.
So it's a strong indicator that their bet on storage as a service is really paying off now.
Very much so. And just to put it in context, subscription services now make up, roughly half of their total revenue.
About 50%. Okay, so the top line numbers, subscription growth strong, but how efficient are they? How's the profitability? The sources also gave us a look, specifically using those non-GAAP numbers.
Right. Companies often give both GAAP and non-GAAP. And non-GAAP, well, it typically excludes certain costs to give what the company sees as a clearer picture of core operational profitability.
So on that non-GAAP basis,
They reported a strong gross margin, 70.9%.
70.9, healthy.
Very healthy.
Mm.
And their non-GAAP operating income came in at $82.7 million. That translates to an operating margin of 10.6%.
Okay, 10.6% non-GAAP op margin. These figures really highlight the underlying efficiency of the business model as it scales up.
Definitely. And they're certainly generating cash, too.
How's the cash flow look?
Significant cash flow, yeah. Operating cash flow for the quarter was $283.9 million.
You should love to.
Free cash flow of $211.6 million. Plus, they maintain a healthy cash position. They're sitting on $1.6 billion in cash, cash equivalents, and marketable securities.
Plenty of cushion there. And using some of that cash, I saw, to return value to shareholders.
That's correct. According to the sources, they returned about $120 million to stockholders, mostly through share repurchases during the quarter.
Okay, so we've got the numbers. Solid growth, incredible SaaS momentum, good profitability, strong cash. But the real deep dive is understanding why. What's powering this performance?
Well, it seems to tie directly back to their core platform and their strategic execution. The sources put a huge emphasis on their unified storage as a service platform.
Which is built on?
Built on their well-known Evergreen architecture.
Let's pause on Evergreen for a second, because it's more than just marketing speak, right? It feels like a fundamental philosophy for them.
Exactly. The whole Evergreen idea is about creating a storage experience where the infrastructure actually gets better over time.
Without the big disruption.
without requiring those disruptive, costly, forklift upgrades you see with traditional storage. It's designed for simplicity, flexibility, energy efficiency,
And reliability.
aiming for continuous improvement and zero planned downtime. Their CEO, Charles Giancarlo, he highlighted that their platform, running on their single Purity operating environment, lets customers unify, virtualize, and modernize their data footprints.
That promised simplification, constant improvement, that seems to be a major driver.
It certainly seems to resonate with a growing customer base.
And the numbers back that up.
They do. According to the reports, they've grown to over 13,500 customers now,
Wow.
including roughly 62% of the Fortune 500. And the satisfaction level seems exceptionally high. They boast a Net Promoter Score, an NPS, of 81.
Okay, for anyone not steeped in industry metrics, NPS basically measures how likely customers are to recommend you. A score of 81 is, well, it's genuinely elite,
It really is. They say it's the highest in the industry.
which strongly suggests customers aren't just buying the tech, they're finding real value. They're loyal.
Very loyal. And beyond the core platform, their strategic moves and product advancements announced this quarter are clearly significant contributors to their momentum.
Like their big play in the AI space that seemed prominent.
Absolutely. They launched FlashBlade XA. It's positioned as a leading data storage platform engineered specifically for demanding AI and high-performance computing workloads.
What makes it suited for AI?
Well, the sources highlight its capabilities for performance, obviously, scalability, and managing just the massive amounts of metadata that come with AI training and inference.
Makes sense. That product's clearly aimed right at a booming market.
No question. And they're also focused on the container world with Portworx, right?
That's right. They released Portworx Enterprise 3.3, enhancing their container data management platform.
And didn't they add VM support?
Yeah, notably, the update added support for traditional VM workloads alongside containers, so that expands its potential use cases.
Broadening the appeal.
And they also announced a partnership with Nutanix for a joint solution targeting virtual workloads, again, broadening their reach there.
And sticking with AI, they really seemed to deepen their relationship with NVIDIA this quarter.
That was a key highlight in the sources, wasn't it?
It really was. They integrated the NVIDIA AI data platform reference design directly into their FlashBlade line, and they secured multiple crucial NVIDIA certifications.
So this isn't just a technical integration, it sounds more strategic.
Exactly. It really solidifies their position as a preferred storage partner within that whole NVIDIA AI ecosystem.
Got it. Any other partnerships of note?
Yeah, a couple more mentioned. They collaborated with SK Hynix on flash storage, optimized for energy efficiency in hyperscale environments, another nod to scale and efficiency. And they expanded their partnership with Rubrik, focusing on enhanced cyber resilience and managing unstructured data.
Okay, so when you pull all these threads together, the platform, the customer satisfaction, those targeted product launches, the strategic partnerships, the slides, also summarized what Pure sees as its unique, sustainable competitive advantages.
Yes, they list things like the Evergreen lifecycle itself, direct-to-flash management.
Which lets them optimize the flash media directly.
Right. Their cloud operating model, the consistency across their product lines, the never-obsolete design philosophy, and their robust scale-up and scale-out capabilities.
And crucially, these aren't just technical features on a slide. They translate directly into tangible, measurable benefits for customers.
Yes, and the sources actually quantified some of those benefits, did they?
They did. They presented figures claiming Pure Flash storage can result in customers using, get this, 80% less power and space compared to existing hard disk systems.
80%, that's huge.
Huge. They also state it requires 2 to 5 times less labor to operate.
Wow.
Is 5 to 10 times more reliable, leading to dramatically fewer service visits, like 10-30 times fewer.
Incredible reliability claim.
And ultimately delivers a greater than 10x lower total cost of ownership, or TCO.
Those aren't small advantages. They represent really significant operational and cost benefits for enterprises.
You mentioned the power savings, 80% less power. The sources also highlighted this point within the broader conversation about sustainability.
Yeah, and this is becoming an increasingly critical factor, isn't it?
Yeah.
Especially as data centers just continue to grow.
The power demands are staggering.
They are. To put it in perspective, data centers globally consume around 1 to 2% of total global power. And storage alone accounts for a big chunk of that, typically 20 to 25%.
So Pure is positioning their technology as a direct answer to that challenge.
Precisely. Their claim that their flash storage consumes 80% less power compared to traditional hard disk systems. That's a powerful statement about improving data center sustainability and energy efficiency.
It's a key part of their value proposition, connecting their tech directly to a major environmental and, frankly, cost concern for businesses.
Absolutely.
Okay, before we look ahead to guidance, there was also an update regarding leadership, a change at the CFO level.
Yes, they announced that Kevon Chrysler, their CFO, is planning to leave the company. He's been there over 5 years.
Okay, is it immediate?
No, the announcement stated he will remain in his role until a successor is named, so ensuring a smooth transition.
And it's notable, I thought, that the sources explicitly clarify that his departure is unrelated to any financial integrity issues.
Yes, that specific detail was included right in the press release,
Right.
likely to preempt any speculation.
Sure, standard practice, but important to state.
Right. And Charles Giancarlo, the CEO, acknowledged Kevon's significant contributions, including helping grow the business and, crucially, leading that absolutely vital transition to the subscription model we've been talking about.
Makes sense. Okay, let's wrap up by looking at the crystal ball, or at least the company's own guidance for the near future. What are they forecasting?
So for the second quarter of fiscal year 2026, they're guiding for revenue of $845 million.
$845 million. How does that compare year over year?
That would represent about 10.6% growth year over year. They also anticipate non-GAAP operating income of $125 million, targeting a 14.8% margin for Q2.
Okay, and looking out at the full fiscal year 2026.
The guidance for total revenue is $3.515 billion,
Which would be.
around 11% growth compared to the current fiscal year they just finished.
Yeah.
And they expect non-GAAP operating income of $595 million for the full year, targeting a 17.0% margin.
17% non-GAAP op margin for the year.
Okay.
And it's always important to remember, as the sources themselves point out.
Yes, the standard caveat.
These are forward-looking statements. Based on current information, actual results can differ due to various market dynamics, risks, all that.
Absolutely. Guidance gives you a picture of management's expectations, but it's definitely not a guarantee.
Right. So let's quickly summarize this deep dive then. Pure Storage had a strong start to their fiscal year 2026. Solid overall revenue growth.
But with particularly explosive momentum in their subscription services, especially storage as a service.
Right. And this performance seems to be driven by their core differentiated platform, that evergreen idea.
Plus continuous product innovation, targeting high-growth areas like AI.
Strategic partnerships, like with NVIDIA and Nutanix.
And those tangible benefits for customers around efficiency, cost, and sustainability.
And we also covered the planned CFO transition, making sure to note it's unrelated to financial integrity.
Yeah, pulling all of that together gives you, I think, a really clear picture of the essential details and the bigger strategic narrative Pure Storage is pursuing right now.
It absolutely does. And maybe it leaves you, the listener, with this to consider. As the demands of data, especially from things like AI and high-performance computing, just continue to skyrocket.
How will the industry respond?
Right.
Yeah.
And what are the long-term implications as the market relentlessly shifts towards these subscription and as-a-service models that companies like Pure Storage are clearly leading the charge on?